Good afternoon, everyone. Sorry for the minor delay. We are up and running. Welcome to AIAD's AutoTalk. I'm your host, Rachel Soleimani. Before we get started, a few quick reminders as always. Anyone that is registered for today's program will be receiving a copy by early next week. And if you have any questions, feel free to enter them into the Q&A bar in the lower right-hand side of your interface. Joining us today from Baker Tilly is Michael Mader, Principal, Dealership Industry Group, and Trevor Dubois, who is having slight technical difficulties but will join shortly, Tax Senior Manager. Michael, I know you guys have a lot to get to today, so I'm going to let you take it away.
All right, thank you, Rachel. And thank you, everyone, for joining us today in navigating 2026 and beyond, looking at the OB3 bill and how it's going to affect your dealership operations moving forward. So our agenda for today, well, let me state first, we have a disclaimer. So this is for informational purposes only. So you all have your own CPAs or accounting firms, and you need to take your information or this information back to them to make sure that any of it applies to your situation, because every dealership and every business has unique circumstances, and not everything that we say today is going to possibly work for your organization. So take it back to your accounting people and talk to them. All right, our agenda today, an introduction of myself and Trevor. We're going to talk about key business tax provisions, the scale back of the clean energy tax credits, which most of you already know, some of them already, some individual and estate tax provision, and then have some open question dialogue towards the end of the session. Okay, as Rachel had mentioned, I'm a principal with Baker Tilly. I have been in the automotive industry space for approximately 33 years, of which 8 of those I started in the industry working in dealerships, ranging from an office manager all the way up to a quasi general manager operating dealerships. I joined public accounting in 2000, and I'm going on my 26th year with Baker Tilly. I started out with Baker Tilly. So Trevor, are you on?
I made it back in. Can you hear me?
All right. Yes. And one thing I want to introduce you all as well is the UPC code on here is up to speed. So every month I put on an up to speed video audio session talking about various different things in the tax, the accounting, and the operations of automotive dealerships. You can click on that QR code and that will get delivered to you on the third Wednesday of every month. Our latest one just went out last week, and that was covering how to utilize capital within your organization to better expand your operations through acquisitions, different things like that. So it was a good topic. All right, Trevor, you want to introduce yourself?
Definitely. Thanks, Mike. My name's Trevor Dubois. I'm a tax senior manager out here in the Pacific Northwest. I sit in the Seattle, Washington area. I've been working with and serving the dealership industry for almost 10 years now. And I'm excited to be back for another AIDA Auto Talk.
All right, thanks, Trevor. All right, things are changing. So a lot of things happen. We just took 100 years to say, hey, what's happened in the last 100 years? And if you look at today's pricing in 2025 of where the different things was, we look at a gallon of gas on average is about $3.21. New vehicle, I believe it's now close to 40 or over $50,000. An ounce of gold. As of today, this was at the end of 2025. As of today, that is now over $5,000 an ounce. It broke the $5,000 an ounce mark. Well, what did it look like 100 years ago? Well, 100 years ago, we look at a gallon of gas and we're at 20 cents a gallon. We look at a vehicle that was $260. Now, that is a Model T vehicle. The most expensive vehicle out there in 1925 was a Rolls-Royce Phantom, and that was less than $30,000. So the average price of beginning price of a new vehicle today is more than what the most expensive one was in 1925. And then again, we have the price of gold that jumped over 5,000 in the last couple of days here. So what has that done? Yes. Yes,
I was going to say, I think silver might be over $100 now as well. So that's kind of extremely fast.
Yes, they've both jumped up. So when we look at taxes have changed significantly over the last 100 years as well. So when you look at this slide, there's income tax brackets, and that doesn't actually look too bad. So tax on $200,000 back in 1925 was at about an 18% rate, $36,760. That tax on that same $200,000 today is only 20%. So it doesn't look like things have changed a whole lot, does it? However, when you take that $200,000 and bring it up to today's value for $200,000, That 200,000 in 1925 is worth $3.6 million today. The tax on that is close to 1.3 million or 36%. So our tax laws have changed quite a bit over the years as well. All right, so let's take a look at some of the key tax provisions. One of the biggest tax provisions that everybody was hoping for was the extension of the QBI, or Qualified Business Income, Section 199A deduction. And what that deduction allows is on flow-through entities or pass-through entities, entities that the income flows through to the shareholders or the members' individual tax returns, gets a 20% deduction automatically. And that was brought in part because when the corporate rates dropped to 21% for C corporations, that leveled out the playing field with S Corp and C Corp in partnership. So that was a big thing that we really wanted to get passed through. One of the things that we see in this qualified business deduction is the aggregation of businesses. We've picked up a number of dealerships over the last couple of years now, and the thing that we're seeing that's being missed is aggregation of the businesses. And what that means is if you own 50%, at least 50% of various businesses, and they all work together, there's some aggregation rules. But let's take, for example, your dealership. You have your operations in your dealership, and you also have real estate that operations are running out of. We've seen it where the real estate was not aggregated into the operations, and thus that 20% is missed on the real estate income. And typically, when you think about it, over time, that real estate entity becomes a very valuable entity, not only in net worth, but also in cash flow, and also tends to have some significantly good taxable income. And thus, you're missing out on the 20%. And we typically will see this is when the CPA firm may do the operations, may do the dealership tax return, and another firm does the individual, because the firm doing the individual is where this aggregation takes place. And you cannot do an amended return. So if you filed 2024 and you missed the aggregation, you cannot file an amended return in order to do that. So one of the things that we do recommend, and probably as a thing that you should take back to your accounting firm, is that you should always amend or extend your returns. What extending your return does is allows you to file a superseded return, and on a superseded return, you can take this aggregation into consideration. And there's other reasons for doing the extension to get that superseded return. There could be things that are in your tax return that may have been missed, or may have an election that you would have chosen on the originally filed return that you might have missed. Under a superseded return, it's as if you filed that return once. So when you file that last return for the year, that's the return that is assumed filed first. So you always want to be able to have a superseded return. So that's why we recommend all of our clients to extend their tax returns. That doesn't mean they're getting done later. That just means we're extending it to ensure that we get the opportunity to have a superseded return if something does change. So when you look at this 20% from a standpoint of a business, let's say we've got $1 million of flow through taxable income. In 2025, under the old rules, you would have gotten a 200,000 deduction. Taxable income, 800,000. Federal tax rate of 37%. You would have paid federal tax of 296,000. Had OB3 not come along and fixed it and made this permanent, in 2026 on that same $1 million, you would have been paying $396,000 in tax. So 26 under OB3, now we're back to that 296,000. So it kind of extended what and made permanent what we've wanted to have all along. Trevor.
Awesome. Thanks, Mike. Last time I did this presentation, or a presentation like this, I said one big, beautiful bill act like 100 times. And so this time I'm going to copy you, Mike, and work on just saying OB3 as we talk through
that
some
is
of these
a good
other
thing, because I got tired of saying one big, beautiful bill or OBBBA, trying to count all the B's in there.
Yeah, OB3 is way easier. So I'm going to summarize another important update from OB3 that also relates back to the 2017 Tax Cuts and Jobs Act. So interest limitation was born out of TCJA, and large businesses with average gross receipts over 25 million, this amount is now 32 million in 2026, are subject to the interest limitation. For the first few years of 163J, interest expense allowed was limited to 30% of EBITDA, highlighting that DNA for depreciation and amortization in there. So businesses got to add back their tax depreciation and amortization expense when calculating their adjusted taxable income. The past few years, this calculation went down to EBIT. So you didn't get to add back depreciation and amortization expense anymore when calculating your adjusted taxable income. This in general had a pretty negative impact for a lot of entities, specifically ones that had new acquisitions in the last couple of years or large construction projects where they might have had large goodwill amortization or lots of interest expense. OB3 now reinstates EBITDA when calculating adjusted taxable income, which is a huge win for businesses and should allow for additional interest deductions as well as more opportunity to take bonus depreciation for dealers. So let's talk about that bonus depreciation real quick. So during the initial planning of TCJA by lawmakers, there was heavy lobbying to help dealers not be penalized by this interest limitation, as pre-COVID profits for dealers indicated that floor plan interest deductibility could be severely limited for many dealers. The result was the option to exclude floor plan interest from the haircut and allow all floor plan interest expense to be deducted. But what was the trade-off? No bonus depreciation would be allowed. I'll walk through an example on the next slide that kind of talks about this. Another new item from OB3 is capitalized interest expense. There were some providers out there that were capitalizing interest instead of running it through the interest limitation calc. There's now two specific interests that can be capitalized on OB3. And then the last one for any dealers that might not only operate car dealerships, maybe they have RV or trailer type dealerships, motor vehicle is now permanently modified to include certain trailers and campers when calculating your floor plan interest and allowing that deduction. One real quick thing too, before I go over the example, to keep in mind, for related parties, if you have any agreements between related parties and one's paying interest expense to the other and is picking up interest income on different tax filings, you could result in a double whammy related to the interest limitation. One entity might be disallowed interest expense, but the other is still picking up interest income. So considering planning that maybe could be done related to that. So now let's walk through this example. And that's a pretty complex thing, so I'll do my best to summarize as best as possible. We have a few assumptions here. So your net income before depreciation is $750,000. Your 5-year assets that were placed in service is $600,000 total in assets. And so that first year, we're going to look at taxable income of $150,000 because we're assuming 100% bonus depreciation on that $600,000 of assets placed in service. So we get from the $750,000 down to $150,000 of taxable income. That's our starting point for our interest limitation calculation. We're going to add back all of our interest expense of $300,000, which also includes $50,000 of floor plan. We don't get to add back depreciation and amortization anymore. Again, this is the rules that were 22, 23, 24, and would have been 25 under TCJ without the update for OB3. So we get our adjusted taxable income of $450,000. 30% of that number is $135,000, and that is what would be allowed for interest expense. Therefore, our excess of $300,000 over the $135,000 is $165,000. And so on our initial calc, we are limited on interest. As a dealership with floor plan interest, you now have to move to column 2 and you don't get to take bonus depreciation, and we restart kind of the calc from the top level. So our taxable income now without taking bonus is $630,000. That's our $750,000 minus $120,000 for regular depreciation without bonus on those assets placed in service. Our interest expense add back will only be $250,000 because we're going to exclude that floor plan interest. We get to deduct that, so we're not going to add that back. Our adjusted taxable income is $880,000. We take 30% of that, $264,000. So now we don't have an excess business interest expense limitation as the 264 is greater than the 250, but we're still not allowed to take that bonus depreciation. So really our taxable income went from $150,000 to $630,000 under TCJA. 2025 now with the updated EBITDA back, we get to run through the same exact calc as column 1, but we're going to add back that $600,000 of bonus depreciation in row 3. We get our adjusted taxable income of $1,050,000, take 30% of that, and it's $315,000. So now we have no initial interest limitation. We get to take all of our interest expense of $300,000, and we get to take bonus depreciation of $600,000 under OB3. So a very good answer going forward for a lot of businesses. All right, another welcome sight from OB3 is the update to bonus depreciation. So TCJA originally was phasing down bonus depreciation by 20% each year starting in 2023. So 2023 bonus depreciation went to 80%, and 2024 it went to 60%, and it would have been 40% in 2025, and that 40% still applies to some assets placed in service at the very beginning of the year. Would have been 20% in 2026 and then 0% in 2027 and beyond. With OB3, we are now back to 100% bonus depreciation. I want to highlight up there in red that January 19th date, which is the day before the inauguration. So 100% bonus depreciation only applies to assets acquired and placed in service after that date. It won't apply to any assets if there was a binding contract existing and or significant construction costs were completed before that January 19th date. One thing I want to mention too with bonus depreciation is that entities can elect to opt out of bonus depreciation by asset class life. So in simple terms, that means you can elect out of 5-year assets or 7-year assets or 15-year assets or 20-year assets, or you can do a group of them together. This is an annual election, so it doesn't carry over year. You can choose each year if you'd like to elect out of any bonus depreciation. There's a few reasons why someone might do this. One quick one is just personal reasons. Some taxpayers like their taxable income more aligning with their book income for planning purposes or income smoothing. There may also be NOL limitations or carry forwards that you're working with, and you don't need to take bonus appreciation or would rather transfer that deductions to future years. Another update with OB3 is the expansion of 179 expensing. So that increased the expensing that you can elect for 179 to 2.5 million for qualified property. If you have assets placed in service over 4 million, you start to phase out on the 179 election that you can make. I want to highlight that 2.5 million that you can take, that is per individual. So if you have a big group of dealerships, separate tax returns, you just want to make sure you're not going over that 2.5 between the full group that would be applicable to you as an individual, as you'd be limited on what you can take. Next slide. So we'll be pretty fast. So as I said, this kind of just shows what TCJ was doing with bonus depreciation, the phase down. Now with OB3, what we're looking like, it's permanent going forward as of right now, so 100% every year going forward. For entities with multi-state activity, just want to highlight that it's important to know that not all states follow federal bonus depreciation rules. Some states follow it exactly. Some need some sort of modification. They're allowed to say they're going to follow Fed. Some do not allow bonus depreciation. So as you work through your extensions for 2025, it's important to consider the state differences for bonus depreciation. And then one opportunity we kind of wanted to highlight is a cost segregation study. So a cost seg study is a detailed engineering-based analysis used in real estate to identify and reclassify personal property assets and land improvements that are typically grouped with your initial building costs. So by doing a cost seg study, you get to segregate some of these costs out. Certain components of property can be depreciated over shorter recovery periods, such as 5 years, 7 years, or 15 years, and then become eligible for bonus depreciation instead of taking all depreciation or all costs, I should say, over the standard straight line of 27.5 or 39 years for residential or commercial property, respectively. So some of the benefits of a cost seg study, like we mentioned, is you get the shorter life assets, so you get to accelerate depreciation, resulting in larger tax deductions in the early years of ownership versus 27.5 or 39 years. By reducing your income with these accelerated deductions, you get to improve cash flow by deferring tax payments and paying less income tax. This can be used on new construction, acquisitions, significant renovations or expansions. And having a properly conducted study is important, as the detailed documentation in that study is what supports future IRS audits if they were to look at your depreciation schedules.
And for dealership facilities, typically what we do see, Trevor, is anywhere from 25 to 35, 40% of that initial cost can be accelerated into shorter lives. So it's a very strong benefit that you can get. And again, when we talk about the aggregation and grouping, when you group it, now it becomes an active business. So now you're able to take that deduction up front on an individual return that you may not have if you don't do the grouping.
Agree.
All right, so let's talk about opportunity zones, since we are now talking about facilities. Building a facility in an opportunity zone is unique and beneficial. So an opportunity zone is an economically distressed community where new investments are eligible for preferential tax treatment. I'm having trouble saying that word. The purpose of the Opportunity Zone program, which was created in the Tax Cuts and Jobs Act of 17, is to stimulate economic growth and job creation in more underserved communities and areas. And the benefit of it is you can invest in these to defer or eliminate some of your capital gains. So if you are in the position that you're going to consider selling your dealership, some of that capital gain can be reinvested in a qualified opportunity zone. This is not, it's a kind of an extension of what was already out there. It was not set to sunset, but there was some changes to it. So under the old rules, the gains were deferred until December 31st of 2026, regardless of whether or not they were realized. So under the new rules, gains are deferred for 5 years. There's also a basis step up. It's a permanent exclusion on the original gain. Under the old rules, 10% of the step up occurred after 5 years and 15% after 7 years. Under the new rule, the 10% is a step up after 5 years and that's it. There's also a permanent exclusion of the subsequential gain. And under the old rule, the basis step up to fair market value at the time of sale if the OZ investment is held more than 10 years. Under the new rules, the basis step up to the fair market value is at the time of the sales if it's at any point within 30 years after the sale of the original investment. So the additional benefits give you some great opportunities that if you've got some substantial capital gains, you can invest them. And it's different from like you think about the 1031 exchanges where you buy a facility, investment facility, you sell that and you defer the gain into another similar investment facility. In this, under that situation under 1031, you have to invest the entire amount of the proceeds for the most part. There are some adjustments to that. However, under the opportunity zones, you only have to invest the capital gain portion. I mean, so it's benefit if you've got a $50 million gain, but you've got $150 million worth of a cash transaction. Under a 1031, you'd have to exchange the entire 150 million. Under the opportunity zone, you only have to exchange the 50 million gain to get the benefit. Okay, Trevor.
All right, I'm going to run through these pretty fast because we're coming up on about only 5 or 6, 7 minutes left. Some other changes impacting businesses. If you're a public company, there's now some new aggregation rules regarding the $1 million executive compensation limit. C Corp charitable contributions, there's now a 1% floor for C Corp charitable deductions. New markets credit, Section 45D, this is made permanent. This is a credit designed to encourage investment in qualified community developments. And there's tax credits available for this investment, so just something to keep in mind. 1099 miscellaneous and non-employee comp is increased to 2,000. It's starting in 2026. And then FML, paid family medical leave, that has been made permanent. It's not, the rules didn't change who receives it, but there's some slight changes to the employer and the options and how they calculate the credit. Some quick notable items not included in the bill that were highly talked about was the PTE deduction. So because TCJA created a SALT cap of 10,000, many states came out with a pass-through entity tax regime where the entities can pay the income taxes and get a deduction for it. They were talking about trying to remove that or figure out a way to remove that. That was not in the final bill. So PTE regimes and the pass-through entity tax deductions are still available. They talked about creating a higher tax for wealthy individuals who make over $1 million. That didn't happen. They also talked about raising rates for corporate above the 21% and also increasing capital gains taxes, the preferential rates you get for that. That didn't happen either.
All right, so clean energy tax credit. So we're going to fly through this as well because most of these have been already put into place. These were revenue raisers to get this budget passed or this bill passed. So when we look at it, the first three are already done. It's September 30th. You guys are all familiar with how that all ended. But the fourth one is the 30C, which is the refueling property. So consider your electric chargers, your charging stations that you're putting in. There is still the ability to get a credit on those charging stations. However, they have to be placed in service prior to June 30th of 2026. One of the things to consider is placed in service means fully running and in function. It doesn't mean just purchasing and paying the bill for it. So you want to get those put into place right away. All right, Section 179D. This isn't talked about a ton, but it's for commercial buildings for energy efficiencies that are deemed to be run on commercial buildings that you get a credit for. And it can be pretty substantial, 58 cents a square foot up to $5.81 a square foot. Depends on prevailing wages. And this is to end again on June 30th of 2026. So if you are in the process of considering to do a re-imaging that may take in some energy efficiencies, or you're building a new building, you may want to get started with construction before June 30th of 2026 to be eligible for these credits. There are some provisions on the construction process on what has to happen and timing and things like that, but you need to get started with the construction prior to June 30th of 2026 in order to be eligible for this credit.
Okay, we'll go over some key individual and estate updates for OB3 as well. So this first slide, the table, this references back on what Mike was talking about in relation to QBI. So if TCJ would have expired, that top tax rate would have gone from 37% to 39%, not 39.6%. Again, this was the pre-TCJ rates. If you combine that with the elimination of QBI, if that would have expired, basically flow through dealership income would have gone from 29.6% rate to a 39.6% rate. So effectively a 33% increase, but that's not happening. We kept the old rates. The increase in salt cap, I'm going to put kind of on this. So the salt cap has been 10,000 for the last 8 or so years. OB3 has said, okay, we're going to increase that salt cap to 40,000 for 2025. However, there is a phase out for high income earners who make between 500 and 600,000 married filing jointly. And that phase out is super important for those that fall into that phase out. If there's any sort of planning you can do to be below that 500,000, I would take a high look at this during extension time, as that 500 to 600,000, effectively that 100,000 increase in income is a 45% tax rate on that $100,000, because you go from taking a 40K salt deduction if you have property taxes or income taxes that get you to that 40K. That 40K is going to be phased out to 10K. So that 100,000 income is effectively increasing at 130,000 with this cap on here. Estate generation skipping tax. So TCJ effectively doubled the estate exemption back in 2017 from 5 million to 10 million, adjusted for inflation. This was set to phase out at the end of 2025. OB3 has said that we're going to basically keep that. We're going to round up to 15 million, and so you get 30 million for a married couple, and we're going to adjust that for inflation going forward as well. This is permanent. Again, we haven't mentioned, but permanent just means that there's no phase out or phase down of this. New lawmakers could always come in and change that. So it's still important to, if you were doing any estate planning and working on any asset transfers to the next generation, to keep working through that and seeing if you can get it completed, as basically the time value of money. If those assets are going to go faster than the inflation, it might still make sense to transfer assets sooner than later. One highlight I want to say is pay attention to law changes for different states, as those are also changing quickly. I live in Washington. Our estate tax has become much more aggressive over here in Washington. So definitely pay attention to any state laws if you live there and plan on living there in the future.
Okay, some additional new provisions impacting individuals. I couldn't tell you how many dealers I had, and I think more on a joking basis, but when somebody says a joke, there's always some seriousness to it. But tip income, it's up to a $25,000 deduction on qualified tips. There's cap limitations on it for income or phase outs. However, one of the things that some dealers called and said, hey, can we reclassify our commissions that are paid to salespeople as tip income? And the answer is no, you cannot. So overtime income deduction, that allows for a $12,500 deduction for overtime compensation for single, $25,000 for married filing joint. And the one thing to remember on this is that it's on the overtime dollars, not on the total wage that's paid during the overtime period. So if somebody is making $30 or paid $20 an hour, their overtime would be $30. Well, the deduction is for the $10 per hour, not the entire $30. There's also a senior enhanced deduction that provides a $6,000 deduction for eligible senior filer. And part of that was brought in because under Trump's running for presidency, he wanted to eliminate the tax on Social Security. So this gives anybody 65 or older the ability to eliminate the majority of their tax on Social Security income. And then we have car loan interest, which I'm sure almost all of you are familiar with, but the car loans is a $10,000 deduction per qualified passenger new vehicle loan interest, not used, only new. And that's good from 2025 through 2028. But again, there are some phase out limitations related to that. Okay, Trevor?
All right. Two more slides. I'm going to run through these pretty quick as well as we're about at time. The charitable deduction floor. So I mentioned there's a C Corp floor. There's now also a floor for individuals of 0.5% of their AGI that you have to get over in order for charitable deductions to even be allowed as a deduction on your itemized schedule. There's also a new limitation. So we had the P's limitation before that basically got paused through TCJA. OB3 permanently gets rid of the P's limitation, but there's a new overall limitation for individuals in the highest tax bracket of 37%. Effectively, you cap your itemized deductions benefit to 35%. They brought back the charitable deduction for non-itemizers. This was around for a couple of years during COVID, where you got to take a deduction on your page one versus on your Schedule A for itemized. They brought this back, so married people can take up to a $2,000 deduction on page one versus on their itemized deductions if they don't itemize. A planning tip regarding charitable, you should spend some time with this if you are a charitable giver. It might make sense going forward that if you give about 20,000 a year or 25,000 a year and you're barely itemizing or barely getting a benefit from that, maybe you bunch those charitable contributions and do 50,000 every couple of years or something like that. You'll get a better dollar for dollar deduction related to those charitable deductions if you do that going forward. So just something to definitely look into and consider. Other ones, child tax credits made permanent. There are phase outs for this as there were before. Those are also made permanent. The extension of the standard deduction. So they went away with personal exemptions during TCJA and increased the standard deduction. Those are both made permanent. It is now $31,500 in 2025 for a married couple for the standard deduction. Again, personal exemptions went away. AMTs also permanently extended the TCJA increase of the AMT exemption amounts. Casualty loss deduction makes the TCJA limitation to federal disasters permanent, but they did add a little change to it. There could be an exception for some certain state declared disasters. And the mortgage interest deduction, TCJA decreased it from $1 million to $750,000. That's also made permanent on your mortgage acquisition. That your interest that can be deducted on Schedule A.
All right, so what's next? I think from a standpoint of a business advisor, we say keep in touch with them. Talk to your tax advisor, make sure that they're understanding the new tax provisions and how they can actually impact you. Take a look at, you haven't filed your tax returns yet. Take a look at some of this stuff now. Consider extending that return so that you've got more time to take a look at it and make sure that everything is handled appropriately to get you the best value for your dollar on the tax planning side. Take a look at your capital expenditure plans. We've got bonus depreciation, we've got enhanced section 179. There's a lot of things that got extended out or increased through this bill. So make sure you're understanding it and making sure your tax advisor is providing you the best benefits you can get. All right. We want to thank you. If anybody has any questions, I don't know, Rachel, do you have any questions out there?
Yes, we had one question come in. Let me read it to you guys. For the 179D credit discussed earlier, you stated that construction must begin by June 30th, 2026. What is considered the beginning of construction?
Well, if you think anytime you watch somebody breaking ground, it's what? It's the yellow ribbon and the shovel scoop full, right? So that is technically could be considered the beginning of construction. However, the way the IRS looks at it is if you're going to begin construction, there are two things that they look at. One is making sure that you continue that construction. So if you take the shovel of dirt and throw it out, and that's the beginning of your construction, and nothing starts for 6 to 9 months later, the IRS may construe that as not the beginning of your construction and lose that opportunity for the credit. The other thing is how much of the construction process you have actually paid for, and they look at about 5% of the total cost of the contract as part of a significant starting of the construction process. So again, the one shovelful of scoop of dirt does not technically qualify you as starting for construction, but it could.
Well, Michael, Trevor, thanks for coming on today. This was some important information, and we appreciate you sharing it with us. Everyone that is headed to NADA, be sure to stop by the Baker Tilly booth located at 4447W. To those on the line, you'll all be receiving a copy of this presentation and recording by early next week. To learn more about AIADA, visit aiada.org. Thanks for joining us, everyone, and have a great day.